Welcome back, millionaires. Today's video is about top 10 stock market tips from Warren Buffett. Here at Millionaire Mindset, we make videos to get you into the right mindset to succeed financially. If you are new, remember to hit that subscribe button, watch till the end, you don't want to miss what we saved for last. Okay, let's get into the video. Warren Buffett's investment advice is timeless. I have lost track of the number of investing mistakes I have made over the years, but almost all of them fall into one of the 10 buckets of investment tips given by Warren Buffett below. By keeping Buffett's investment advice in mind, investors can sidestep some of the common traps that damage returns and jeopardize financial goals. After much deliberation, I settled on my 10 favorite Warren Buffett investing tips in the list below. Number 10, invest in what you know, and nothing more. Never invest in a business you cannot understand. Warren Buffett. This doesn't mean we can't invest capital in these areas of the market, but we should approach with caution. One of the easiest ways to make an avoidable mistake is getting involved in investments that are overly complex. Many of us have spent our entire careers working in no more than a handful of different industries. We probably have a reasonably strong grasp on how these particular markets work and who the best companies are in the space. However, the far majority of publicly traded companies participate in industries we have little to no direct experience in. Number 9. Never compromise on business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high-quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Some investors might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. Berkshire was in the textile manufacturing industry, and Buffett was enticed to buy the business because the price looked cheap. These insights led Buffett to coin the following well-known quote: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Warren Buffett. Number 8. When you buy a stock, plan to hold it forever. Once a high-quality business has been purchased at a reasonable price, how long should it be held? If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett. Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent businesses that continue to have a bright long-term future. Furthermore, quality businesses earn high returns and increase in value over time. Just like Warren Buffett said, time is the friend of the wonderful business. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. Number 7. Diversification can be dangerous. In my view, individual investors gain most of the benefits of diversification when they own between 20 and 60 stocks across a number of different industries. However, many mutual funds own hundreds of stocks in a portfolio. Warren Buffett is the exact opposite. Back in 1960, Buffett's largest position was a whopping 35% of his entire portfolio. When such an opportunity arises, he pounces. Opportunities come infrequently. When it rains gold, put out the buck, not the thimble. Warren Buffett. On the other end of the spectrum, some investors excessively diversify their portfolios out of fear and/or ignorance. Owning 100 stocks makes it virtually impossible for an investor to keep tabs on current events impacting their companies. Number 6. Most news is noise, not news. There is no shortage of financial news hitting my inbox each day. While I am a notorious headline reader, I brush off almost all of the information pushed my way. The 80-20 rule claims that around 80% of outcomes can be attributed to 20% of the causes for an event. There is no shortage of financial news hitting my inbox each day. Number 5. Investing isn't rocket science, but there is no easy button. Perhaps one of the greatest misconceptions about investing is that only sophisticated people can successfully pick stocks. However, raw intelligence is arguably one of the least predictive factors of investment success. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Warren Buffett. It doesn't take a genius to follow after Warren Buffett's investment philosophy, but it is remarkably difficult for anyone to consistently beat the market and sidestep behavioral mistakes. Number 4. Know the difference between price and value. Many bargains were available during the financial crisis because investors were quick to sell off all companies, regardless of their business quality and long-term earnings potential. Many firms continued to strengthen their competitive advantages during the downturn and emerged from the crisis with even brighter futures. In other words, a company's stock price was, temporarily, separated from its underlying business value. During the extraordinary financial panic that occurred late in 2008, I never gave a thought to selling my farm or New York real estate, even though a severe recession was clearly brewing. And, if I had owned 100% of a solid business with good long-term prospects, it would have been foolish for me to even consider dumping it. So why would I have sold my stocks that were small participations in wonderful businesses? True, any one of them might eventually disappoint, but as a group they were certain to do well. Warren Buffett. As long-term investors, we need to heed Warren Buffett's investment advice to buy quality when it is marked down in price. Price is what you pay. Value is what you get. Warren Buffett. Number 3. The best moves are usually boring. Investing is not meant to be exciting, and dividend growth investing in particular is a conservative strategy. Rather than try to find the next major winner in an emerging industry, it is often better to invest in companies that have already proven their worth. We make no attempt to pick the few winners that will emerge from an ocean of unproven enterprises. We're not smart enough to do that, and we know it. Warren Buffett. After all, the goal is to find quality businesses that will compound in value over the course of many years. If we get this right, our portfolio's return will take care of itself. Number 2. Low-cost index funds are sensible for most investors. We hurt our performance in many different ways, trying to time the market, taking excessive risks, trading on emotions, venturing outside our circle of competence, and more. Even worse, many actively managed investment funds charge excessive fees that eat away returns and dividend income. Despite his status as arguably the most prolific stock picker of all time, Warren Buffett advocates for passive index funds in his 2013 shareholder letter. Once Buffett passes away and his Berkshire Hathaway shares are given to charity, Buffett's trustee has clear instructions to follow. My advice to the trustee couldn't be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions or individuals, who employ high-fee managers. Warren Buffett. Number 1. Only listen to those you know and trust. Throughout his shareholder letters and occasional interviews, Warren Buffett emphasizes the importance of only investing in trustworthy, competent management teams. Simply put, Warren Buffett is very careful when it comes to selecting his business partners and managers. Their actions can make or break an investment for many years to come. Once management shows itself insensitive to the interests of owners, shareholders will suffer a long time from the price-value ratio afforded their stock, relative to other stocks, no matter what assurances management gives that the value-diluting action taken was a one-of-a-kind event. Warren Buffett. What do you think about our list? Let us know in the comment section below, and subscribe to our YouTube channel for more upcoming videos. See you in the next videos.